the biggest bank crash since Lehman Brothers might have had a bigger impact on sleep this weekend than daylight savings time. I'm Trevor Miller from Cherry Hill Private Wealth. We're going to take a look at what happened with Silicon Valley Bank this weekend. Most banks shut down for the weekend, but Silicon Valley Bank was shut down permanently right before the weekend when the FDIC was forced to step in. And this happened really fast. On Tuesday, CEO Greg Becker was at an investor conference answering some questions about what he does for leisure. And soon afterwards, sold $21 billion in bonds, taking a $1.8 billion loss on that move. When this wasn't enough, he attempted to raise an additional $2.25 billion, which caused a run on the bank. So what the heck happened, and why does this actually matter to us in Canada and the industry as a whole? In the review, what happened was pretty obvious. So let's start with why it actually matters. The Federal Deposit Insurance Corporation, or FDIC, insures deposits at an institution in the case of insolvency. So like what we're seeing here. In Canada, we have something similar. It's called the CDIC. And what basically happens is the FDIC insures deposits of up to $250,000 per account, which for a lot of people is sufficient, right? But SVB, however, was a bank that primarily worked with startup companies and other tech firms in California. So companies such as Roku had large portions of their operating capital with SVB and weren't protected by the FDIC. So essentially, they're a luck, and so were their employees, since these companies couldn't access their bank accounts, making payroll impossible. SVB had about $151.6 billion in uninsured deposits, which really made up the vast majority of all their deposits at the bank. Now, eventually, these companies would get back most of their money, somewhere in that 90%. But this could take months or even years, and that would make it pretty impossible to keep afloat during that time. Several CEOs of these startups vowed to pay their employees with their own money, and some companies had incredible sales over the weekend to try and produce cash to make payroll and other expenses. One company even used Bank Run as a tongue-in-cheek coupon code to try and access some of this cash. So why did this happen? SVB grew from $55 billion in January of 2020 to $186 billion by the end of 2022. So pretty incredible growth over that period of time. And this largely came from the clientele, which is extremely concentrated in the tech company, which is a bit of a problem when, as you can remember, we moved into a bit of a tech world throughout the pandemic. These companies were doing very well. They also banked about half of all IPOs in the past couple of years. In the past several months, the tech industry has been moving slowly, and many of these customers now had to draw and pull some of their deposits back. And they tried to withdraw about $42 billion this past week, which is about a quarter of all deposits. So why is this an issue? You have to bank your money, you should be able to get it out when you want, right? Well, when you give the money to a bank, they then turn around and lend it at a much higher rate. So your credit cards, loans, mortgages, things like that. With the tech industry doing so well and making up most of the customers, they weren't needing loans throughout 2020 and 2021. So what SVB did to try and make some money on this was they turned around and used these funds into high yield, long-term government bonds and 10-year mortgage-backed securities, paying the 1.5% instead of the short-term treasuries that were paying 0.25%. There are some other issues, like them not having a chief risk officer for 8 months last year, which tells you really how they feel on risk management. So as the FDIC was stepping in, and accounts greater than 250 are not insured, there's some panic in the industry. The government said they wouldn't bail out SVB, but as of Sunday night, they figured out a way, and regulators announced that they would safeguard all deposits, including those not regularly covered. So it wasn't a bailout. I'll tell you a little bit about why that was and why that's important. And there's a provision where they can insure some of these funds if there's a systematic risk to the financial system. U.S. taxpayers won't pay for this, as banks that fund the insurance will pay for the losses. It's going to cover the deposits. Anybody who's invested in either equity or bonds, they will be having losses in this. And in Canada, OSFI took control of SVP's Canadian operations. According to the Council of Canadian Innovators, the bank's closing does not seem to have a systematic issue for any of our companies in Canada. And although our banking systems are drastically different than that in the US, it's a good reminder to know what protections your financial institutions give you. So make sure you ask the questions and know the risks associated with any deposits or investments you do in Canada as well. Hope you enjoyed. Let me know if you have any questions. Hope to hear from you soon. Take care.